And, interest rates with a bank, 4-ish% as we record this, right? Hard money is going to be close to 10% with a couple of points on the front, right? A couple percentage of your loan amount. So, all right, we've got our land, it's developed, it's ready to build on. What about construction financing? What comments do you have there? Thoughts?
I think when people hear of a construction finance or construction loan, if they haven't been through it, they get a little bit nervous. It's a little bit foreign or unknown. But once you've been through the process and understand it, it's not as scary or intimidating. But typically is what you can plan on is a construction lender is going to want to see at least 25% down, and you're going to plan on some buying cost or closing cost. And so you need to understand, okay, what's in that buying cost, closing cost, just like with any other loan that we're talking about here, right? And so a lot of times in the buying cost, you're going to see a interest reserve account. You can either pay on that monthly a lot of times, or it could be paid up front. That's how we do it. We collect 12 months up front, and we have that held in an interest reserve account. So when you're getting a construction loan, it's interest only. Plan on paying the either monthly payment for that loan or up front. There's going to usually be a 1% origination fee, maybe more. You're going to see appraisal fee, closing costs, things like that.
Okay.
And then I think it also depends on, are you going to have to go commercial, or are you going to be able to do residential, right? Depending on the amount of doors. So we've done projects where anywhere from 1 to 4 doors, we can get you residential, and then 5 and above, you need to go commercial. Terms are usually not as favorable commercial, but they still do work.
Yeah.
And sometimes that process is a lot harder. But through commercial, you can also do it in the name of an LLC, where you go in residential, it has to be in your personal name.
That's right. Going residential, once again, this is a bank, and they have very set requirements. When we say going residential, we're talking about these conforming Fannie Mae loans. And there is a very specific set of criteria that you have to go through, and you either meet it or you do not. Very rarely is it blurry. One thing that happens to me a lot is when I send somebody to a commercial lender that's been used to dealing with residential, they always call me like 60 days later mad. Like, these commercial guys are clowns. I'm like, well, there's not a criteria, right? This is a bunch of old bankers that collect all your financials and get in a committee, eat some donuts, and talk about, do we like this guy? And black and white answers don't always come out of that meeting, right? So commercial is, there's like a thought that's expressed a lot. People say, I want to do commercial deal because they don't care about my credit score or my financials. They just care about the deal. Not true at all. But what is true, they care a lot more about the deal. On a residential loan, it is Chase's credit score and debt to income ratio purely that does that deal. On a commercial deal, is Chase an idiot? Okay, he's not. Is he financially viable? Is he solvent? Great. Now, how does this deal look? Right? Because it doesn't matter how good you look if the deal doesn't look good. It has to stand on its own.
Thanks for listening to the Build to Rent podcast. You are now just a few clicks away from joining our community of Build to Rent investors. All you have to do is follow our show on Facebook, LinkedIn, or wherever you're listening to this podcast. You can also watch this episode and more by subscribing to the Build to Rent podcast on YouTube.